I'm here with Craig McMahon from Villanova University, and he's going to talk to us about some history in fintech. But first, I wanted to give a little bit of background about yourself, Craig, and talk about this great book that you have forthcoming. I looked it up, and I was disappointed to see it's not actually in print yet, but it's on the way.
Sure, well, that would be two of us at this point. Yeah, so my actually path to academics was very much influenced by my financial services career. So now I'm going on over over 20 years at this point, working in finance and consulting, particularly started in capital markets with mergers and acquisitions and private equity, but always sort of had an interest in the pace of research that academics allows, as opposed to the constant pace of transaction services. So I ultimately ended up in academics researching the things I was very interested in as a financial professional. So they really informed each other. So I spent a lot of time looking at financial crises in particular, and how they develop, how banking systems develop, particularly over the 20th century United States. So there's fun things like how we get from small little regional banks up to big universal banks in the United States. And I tell my students, we just ask a couple questions. How do the banks get their money and what do they do with their money? But it's fascinating that there's so many variety of options when it comes to financial services.
So it's really fascinating to me, like the whole history part that I've not studied sufficiently, and that's one reason I have you on now. So of course, you think fintech, that's about the future, right? It's technology, it's cool. Why do we care about the past? Why do we care about how it has developed? I just care about the future.
Sure, right. That's a great question. And so, someone who looks at financial history, again, it started pretty practical for me. I remember I was in the office of today, what is now one of the founders, he's in his 70s, of one of the world's largest private equity funds. And on his bookshelf was what is now a famous book by, or still remains a famous book by Kindleberger, which is about manias, panics, and crashes. It's in 8th edition. It's actually outlived him. We have other folks who keep updating it. But he said, that's the only book that he kept from college. And he was in his late 60s at that point, now in his late 70s. And I thought, I never really thought about it that way. And so it's not that history allows us to predict the future, but it can help inform what's possible and how we make decisions. And so particularly when it comes to the crisis and innovation, something that interests me is how do we react to these things just as human beings? And it turns out there's some things we can learn from looking back over history. How did people react when, for instance, there was innovation in finance? How do people react during a crisis? And it doesn't provide us with an exact blueprint, but I think the more that we know of what's happened in the past, we can at least differentiate our responses, or at least have better informed responses about the time we're living in. And so fintech, as innovative as it is, I look at it as a delivery mechanism. And so the fundamentals of what is important when it comes to, for instance, banking, or it comes to financial services, those aren't suspended, but they are changed. And so it's both an opportunity, but that opportunity doesn't change some of the fundamentals of economics and finance, which we'll get into today.
Right. And I think one of the things we want to start with is you've done some research into unsecured consumer loans.
Right.
So kind of walk through that case of how the history you've learned of consumer loans can inform us about what's happening today and may happen in the future.
Yeah. So, if we think about how much the consumer has changed in terms of his or her access to finance because of technology, a lot of that is on our phone. And when it comes to unsecured lending, so somebody can take out a small, say $100, $200 loan up to something larger, be it from a traditional financial service company to crowdfunding, all these different options out there. And so a question I ask is, well, how far does this go back? And of course, it goes back as far as we can imagine in terms of people needing money. But really, the idea of once people started getting paid in cash, so you can kind of think about the Industrial Revolution, it turns out that weekly budgets don't always match how much cash people are bringing in. And almost immediately in big urban centers, for instance, London and New York, you had companies that started specializing in making small loans to workers. And so what was really innovated was, how do you estimate and understand a person's credit risk who is borrowing small sums? So today I'll use that example of $200. In the past, maybe it was $5 or $10. And that's a totally different thought process. It's expensive to lend to people, whether they're rich or poor, because you have to go through a process. And so you hone in on that process, whether it's 1890 or 2021. And what we learned and what we saw happen both in the United Kingdom and the US, which is where I tend to do my most studies, is that the private market provides a solution. People needed this money. They often need the money just simply to pay their bills. Say there's an emergency expense. Typically, this kind of consumer lending is not for something extravagant. It's often not even to acquire a consumer good. It really is a small cash loan to help balance the budgets. And so these small companies that, again, I'll say 1890 to the 1900s, developed a specialty of lending to people small sums that get paid back during the next paycheck. So we can think of a payday loan. Literally in the name, you pay back on the day you get your next check. Well, again, that's been around for a long time. And so what we saw in the past is that regulators, so we instantly think of when it comes to financial innovation, what's the relationship with regulation? And that's something else we want to keep in mind for fintechs. And so regulators in the early 1900s let this market grow. They didn't hone in on it. Often the people we think of who take these loans aren't the ones with the loudest voices in the political sphere. And so these things tend to go under the radar for some period of time. Once it gets on the regulator's radar, so it took a period of growth and success. So that's another sort of takeaway from what history teaches us when it comes to these particular unsecured consumer loan products, is that when you get really good at this job, you get good at developing this market, meaning you grow and you advertise and you become more well-known, you attract the attention of regulators. And so with success comes scrutiny. And with that scrutiny comes really sort of the first regulatory mechanisms for these loans. And what starts to happen is people tend not to like these kind of products. And so we can understand today, we have technology that's helping deliver loan products to people in low income brackets. Usually these technologies have some leeway. There are multiple platforms. There's multiple ways for savers to get money to people who need it, the demand. And these small amounts, again, are typically for low-income folks. The platform of fintech is going to sound really interesting, but you still have to price your credit right. You still have to ensure that your default rates are manageable such that you're an ongoing viable business. That's the same whether it's 1900 or it's 2020, 2021. And what can happen in this market is that once this model is figured out, be it fintech or be it 1900, regulators and the public start to catch on to, wow, there seems that these fees are pretty high. It seems that these interest rates are pretty high. Are these predatory loans? Are you taking advantage of the working poor? And those are questions that typically the business community wasn't asking in the first instance because they were responding to demand in the market. What those questions don't answer, and they're really important questions, is what happens when regulation comes in, but the demand for the loans doesn't change. And that's where we can get in some really sticky situations in terms of financial innovation. There's a market need, there's a market demand, and sometimes regulators will step in and regulate the supply without addressing any of the market demand. And so one takeaway that I've seen is for innovators and particularly when it comes to finance and fintech is to appreciate your regulatory strategy from the onset. Once you start lending money to people, and especially to lower income brackets, you will at one point or another attract the interest of the state. And this is pretty much cross-cultural as well, not just in the United States. And what you can find is when you're caught flat-footed, in the extreme, they can regulate your market out of existence, right? You can decide that your product's completely predatory, it serves no purpose, it traps people in debt. Now that might not be their case, but it's certainly a very convenient narrative. And so if you have the ability to think through and engage your market strategy and politics and regulation is not on the forefront of your mind, I would suggest that is part of your initial strategy with any type of financial innovation, but in particular for consumer loans and consumer products. You can't let the market demand get ahead of where you, at least looking at this for 120 years, where you will end up is attracting the interest of the state. Now, I can't tell the exact strategy. We see this with technology companies today that aren't necessarily involved in finance. We see big tech right now as being scrutinized around the globe for its interaction with consumers. They're obviously at a point now in their market that's quite different from a startup fintech company. But when it comes to that relationship, it is inevitable. Another example we have is the sandbox regulation, which is attributed to the United Kingdom, but where regulators basically put your company in a little box and they segment it outside of the regulatory financial structure. And they say, we're going to let you grow, we're going to let you experiment, we're going to lift some of our regulatory measures. But the expectation should not be that those will be lifted forever. It's that you're likely to fall under a regular financial regime at some point. And so again, it gets to your planning phase. So at what point and what strategy do you start engaging the regulatory mechanism? Because it can be, if it's too late, you could find much of your market and your profits evaporate. And that's regardless of the demand for the product. You could have a great product, but the supply of that product is questioned. And then all of your hard work and supplying something to the market could evaporate very, very quickly. So I think that's sort of important takeaways when you're dealing with consumers.
So I have a few questions, and Daniel, of course, jump in
Sure.
Whenever. I don't know if this was in your research, but in the early 1900s, when these, I'll call them payday loans, were first coming out, do you have any idea how people looked at credit risk then? It seems like that would be different than how we would do it today.
Again, if you inappropriately price risk, you will run out of cash and you will run out of the business.
Right.
And so these were some sophisticated processes. Of course, there were paper applications. There were lengthy questions. They would actually send sometimes people to your home as a way to judge your credit risk. So this upfront costs are pretty expensive. Even with today's technology, with online payday lending, it often takes 2 or 3 loans before that particular customer is profitable, because the setup costs for initial credit applications are pretty high. And if you're spreading that setup cost around, say, a $20 fee, it takes a while for you to earn that revenue back. And so, yeah, in 1900, they weren't looking at social media accounts and they weren't scraping data, right, but they were collecting a lot of data points. And so you could think of almost agents, acting as agents to build what we would say is a pretty sophisticated credit profile, concerned with what other debts do you have? What's your steady employment? What type of furniture do you own? Where do you live? What kind of rent do you have? In order to assess that type of credit. So it wasn't a credit score per se, but it was a pretty sophisticated way of assessing risk.
It was their best attempt at a credit score. So the thought process is exactly the same as today, maybe with the technology. So there, for example, there's one firm that does geofencing that knows that you've been at work or you haven't been at work. So I can assess your risk that way. So we'll switch to another topic about technology and investing, and it's changed the way we've invested. I know you mentioned the gentleman who had Manias and Crashes, that book. Is there anything today in February of 2021 that may look like a mania that has anything that we could look back on?
Yeah, and in this case, we don't have to go too far back in history for most of us, although students may find it ancient history. Just 20 years ago, and I think that's probably the most relevant when we think about.
Yeah. So Daniel, is that ancient history to you? Just.
I think I was an infant, but I am well versed on that.
And there, the big takeaway is how do investors and markets, both professional institutional investors and retail investors, react to financial innovation or innovation in general that requires finance? And so while fintech is a particular marriage of innovation and finance, another way to think about this is how do the people supplying the capital react to innovation in general and technological innovation? And so if our first takeaway was how do regulators react to potential innovations and innovation, this is how do investors react to innovation. And so the newspaper now and again will talk about this internet bubble in the late 1990s. But there are some really important takeaways there. And again, this gets to the fundamentals of economics and finance are not suspended by technology. And so what we mean by that, the big question people have to ask themselves, or suggest asking, is what's the road to profitability? And so no matter how snazzy your technology is, there has to be economic viability. There has to be a market in order for commercial application. Now, there are lots of reasons to invent things for the common good, but if you're an entrepreneur, there has to be commercial application for that finance. And so what we saw back in 2000 were two stages. So we'll deal with what many would call a mania or a bubble, not to get into efficient market hypotheses, but that there was such enthusiasm about technology that investors were willing to suspend the road to profitability. And so it was simply gain market share. It was this idea of networking effect. So if you add one more user to your base, eventually you'll become profitable. And we saw that from the venture capital stage to the retail stage of investors, people were willing to put substantial amounts of money into technology through the seed money to the IPO stage, and started to evaluate companies differently. And so we saw a willingness to come up with new financial metrics. So for instance, then the internet was novel. So it was sort of how many eyeballs on your webpage, how many visitors on your webpage, how many users, how much subscription, with very little appreciation of how profitable are those views. How long will it take for you to break even? And what became the mania was really a willingness to invest in a growth strategy that was beyond a horizon of any foreseeable prediction. And we saw in that case, most companies that offered a .com solution had wildly different evaluation opportunities beyond what is the fundamental of the future cash flows this company will generate, discounted to some type of reasonable measure today. And I think what fintech companies are offering us are a variety of really, really interesting platforms, but that doesn't suspend the reality of the market. And so are there reasons that that company might be successful? Sure, you could get bought out, you could have some interesting technology, you could have a good bolt-on to existing banking, but ultimately for a widespread investor base, there has to be profits. And if anything, what 2000 speaks to is the a willingness of very smart institutional investors and retail investors. And typically retail investors are the ones who lose out in the end because the institutional investors have the opportunity to sell out before the retail investors come on. So maybe you make an early seed money investment, and then when you IPO, 3 months later, that stock isn't worth very much, but the big money is out before the retail investors get in. And so I think there's a big, big takeaway to be very, very aware of the difference between technological viability and economic viability. And ultimately, as investment opportunities, those two things have to be wed together. And that's proven whether it's the year 2000 or whether it's 2021, or you can go even further back in history. Technological diffusion, so how technology diffuses through an economy, is dependent upon commercial application. And so the basic fundamentals don't disappear simply because the decades wear on.
So certainly technology has made it easier for a retail investor to get in at an early stage. So 20 years ago, 30 years ago, if I wanted to start a company, it was maybe harder to find people who could invest. But now with payment companies come along and Cash App, CrowdStar, all these crowdfunding mechanisms, do you think that that is going to be better for the economy, that those retail, if regulations allow it, that people can come into those early stage companies? Or do you fear that people will be taken advantage of because they'll come with this new shiny product? And Daniel, by the way, has, I don't know if he wants to, how much he wants to talk about, but he started his own company.
Okay.
And so I'd be interested, Daniel, can you want to tell us any about the way you started to fund the business, or any plans you would want to, or do you want to keep that confidential for now?
Oh no, I'll definitely jump in, and perhaps maybe I can take a swing at your question and then address my startup. But I think in terms of vehicles that are in place, I think that the ability to allow retail investors to come to the stock market is great for everyone because it increases economic growth. I think, there are investment vehicles like mutual funds and index funds that have democratized the stock market and allowed retail investors to come in. And I think now, even with these fintech companies coming in place, they're allowing micro investing to be able to come in place through Cash App, Robinhood, as you saw with GameStop. And I think it's just good for all, especially because as there's more players in the industry, then you're seeing zero commissions and things of that sort still helps individuals such as myself that are retail investors. And then I guess with that said, I'll go. So my name is Daniel Hadgu, and I actually have a company called EthioPay, which is a SaaS platform that allows individuals to invest in the US stock market, pay their bills directly, fund transfer, and purchase mobile top-up between United States and Ethiopia. And so that's why I think, when you came to the investment piece, that really touched home.
And there's so many great points that you touched upon, and I particularly again get back to the regulatory realm. A lot of really interesting fintech experimentation is happening outside of what we deem the traditional rich world, and that's simply because there's an ability to leapfrog over existing platforms. And so anyone who's interested in fintech really has to have their eyes well beyond the American and European market to global markets. And the level of entrepreneurship, particularly throughout the continent of Africa, is actually so hopeful for so many people who watch this, is that there are real problems being solved on the ground. So I'll use our terminology of there's real market demand and entrepreneurship being fulfilled at a level that we've never seen. And so to say that I'm wildly optimistic about how technology can increase market participation would be an understatement. Where I'm cautious is I like to put this in different perspectives. And so I can remember when WebMD came online, and it didn't take too long for people to start, when they went to the doctor's office, there was a difference between being well-informed and acting as if you were the one who went to med school. And in the same way, there are wonderful opportunities to drive down costs. And so competitions in the financial services are ripe. We all know, if we can think about traditional mainline banking, the type of fees we pay, and how, for instance, you're more likely to have a wide array of life events. You're very unlikely to change your checking account to a different bank. It's not a terribly competitive market. So to the extent that fintech can drive down costs, that's a win. That's a win for the consumer, without a doubt. Where I think we need to be careful, and we have to balance, how do we understand and nurture safely retail participation in the markets? So to Daniel's point, if we're allocating capital more efficiently, that's exactly how markets should work. If we're empowering more people to participate in the market through technology, then we are in fact having the opportunity for increased economic growth. That's 100% accurate. If entrepreneurs have lower barriers to capital, absolutely. What we want to be careful with is, just like I would not perform certain medical procedures on myself or diagnose people myself, is to what extent do we rely on people who do this each and every day of their lives versus taking everything into my own hands? And it's the same way that if I'm going to manage my own portfolio, if you're a busy person, you might actually opt to pay someone to do that for you. You might have the skills and the intelligence and the background to do it, but you simply don't have the time to be a market watcher. And so that's where I think we have to really figure out, how is it we provide the right tools to retail investors to increase market efficiency, to allocate capital more efficiently, to allow the retail investor to be able to fund projects that they find viable, without some of that downside risk of someone losing their savings. And we don't have a formula for that yet. What we do know, and the history is very clear on this, this is actually a second book that's coming out that I'm working on. The research of the empire of information disclosure is useless in terms of how consumers make decisions. So you and I all know we click right through terms and conditions, whether they're for a web page or they're for your credit card. We don't read those. And so that is more a legal mechanism to ensure the company has fulfilled the burden of proof, but that doesn't impact how we make decisions. And so that's where I think some exciting things are happening in behavioral finance and behavioral economics, in terms of how can we help consumers make informed decisions that are outside reading 20-page documents. So Daniel, that's where I'd want to see. I'd want to see entrepreneurs like yourself have access to funding, where in the past, a venture capital fund is not going to sit down with you in all likelihood as a first-time entrepreneur with a small capital need. But if there's a way that crowdfunding could do that, but do that in a way that the retail investors are aware of the risks and within the confines of their own portfolio. So I'm sure, an entrepreneur like yourself, if somebody said, look, this is my life savings at $5,000 and I want to put it solely 100% in your company, you might counsel that person to do something different. And that's where we have to figure out. So this gets perfectly to fintech. Is so, we have, at least in my interest, in my wheelhouse, would be 120 years of behavior when it comes to allocating small amounts of capital. And how do we draw on that history to protect investors without inhibiting growth? And that's always a balance, because I firmly believe that we deal in social science, we don't deal in hard science. And so we have to give the best tools to human beings, understanding there's a wide spectrum of behavior.
So I think you bring out some really great points, Craig. And Daniel, for example, has a chance to make two different groups of people make their lives much better. One, the end users of his service, because it's a need that he's identified. The company can be great. The other, are there small time investors around in Daniel's network that may like to invest in this, and they could get generational wealth if he's successful.
Right.
Within the problem comes in of, well, what if he's not a high quality individual with a great idea like Daniel? So how do we protect in your terms of service? Like we're on Zoom right now. I have no idea what the terms of service are. I may have given them permission to take my house. I don't know. So I think that is a real great point. The other, as you mentioned, you need to have a plan for regulation. And it's February 17th, 2021 right now. I heard on CNBC this morning that the CEO of Robinhood and the CEO of Reddit are going to be hauled before Congress to testify. Apparently they had no plan for how to respond to regulators if this happened. So those are great points. I want to move to the next thing, and that is cryptocurrencies and Bitcoin. And here I'm going to tell you, somewhat sarcastically, Craig, there's no way history can teach us anything about cryptocurrencies, because Bitcoin and the supporting technology is brand new. We've never seen this before, right? Or did I miss something?
Well, again, I would say yes and no. We have seen some very similar mechanisms. Again, what I encourage people to do is wherever your niche is in this market, go back and figure out what demand are you fulfilling, and are there similar products out there in history that can help inform how markets, and again, markets are composed of people, so how people might interact. And so I think a lot of people will be surprised that there are pockets throughout history going back centuries of private currencies. Now, of course, the technology is different, and distributed ledgers are different, and the way that people interact through technology are different. But the history of private currencies is both well documented and I think informative, Jonathan. And so here, more so perhaps even than the first two examples of regulation, I'd like to circle back to that before we finish. But in this particular instance, remember what you're competing against. You're competing against a sovereign currency. And so the word sovereign immediately dictates what potentially could happen. And so what we see is when there is a type of market failure when it comes to currencies, so the sovereign currency is not fulfilling a demand. It could be simply throughout history that literally there wasn't enough metal coins floating around. And so the markets develop a system of private currencies. It could have been inflationary in that the sovereign currency was inflated. And so private individuals come up with a private currency system very much similar to what we see today in terms of fulfilling a type of market need. So where is this different? Well, we don't have a currency shortage at this point. We don't run out of metal anymore. There's plenty of paper. We live in a low to no inflationary environment, depending, of course, what happens over the next 24 months. And so what is the market need? Well, there is something different. Of course, the anonymous features of certain types of digital and cryptocurrencies are attractive, but we already see that being chipped away at through the increased involvement of the state. And so when it comes to cryptocurrencies, I think you have to look back and again say, so what 3 or 4 demand features is this product meeting? How is it meeting them? And what are their potential responses to the market? So why are people demanding this? And then we can start to see, again, compare and contrast throughout history. But what we see consistently is that once the sovereign has identified the benefits of the private currency, they either adopt them. And so, for instance, we actually saw when the technology of this of the essentially the equivalent of the printing press and the minting machine, that was all private market solution. And once the state saw the value of that innovation, it co-opted it, and essentially all of the copper in a particular nation was then geared toward the sovereign coin. So how might that work in cryptocurrencies? If the nation feels that their sovereign currency is under threat, you'd have to be very hard pressed to convince me that the crypto market would not have a regulatory response that would severely hinder its ability to operate. And that could quite literally happen much faster than a type of regulation that has to kind of go through a congressional process. So if you can think about if the Fed, so the most powerful central bank in the history of the world, and the US dollar, the global currency, at some point, if decision makers view the supremacy of the dollar as under threat, they will for sure react. I don't like to predict the future, but I think you can get pretty comfortable with the idea that if we talk about a medium of exchange and we talk about a store of value, which are 2 of the major ways that currencies function, if there's a stability in the price, which we don't have right now with cryptocurrency, right? We don't know its future pricing. We have no idea what it's going to be valued tomorrow. We like the US dollar because we know more or less it's going to be valued even 12 months from now. And we can't pay a lot with cryptocurrency, although that's changing. But if those 2 pieces come into line, where we have high confidence in the unit as a store of value and the unit as a payment mechanism, the ability for the sovereign to respond is fast and swift. I don't think it would go through the halls of Congress. I think it would be swift reaction by Treasury and the Fed. I think what's more likely to happen is that it gets co-opted. The best of pieces get co-opted by existing institutions, and then you can regulate the edges to fulfill the needs of the state. So the history of private currencies are well documented, and the outcomes are pretty similar across time, because currency is really one of the almost absolutes of a sovereign nation, is to regulate payment systems.
The coin of the realm. Right?
Coin of the realm. Yeah.
The reason that's a phrase.
Yeah. And what made me think of perhaps something to tie this together as students are thinking and understanding risk factors. When it comes to the long history of financial regulation, I'd encourage you to look at the tone and the rationale. And so what we see more recently when it comes to, and by recently I mean the last 50 to 75 years, is a sense of justice within finance and regulation and fairness. The other side of that is regulation as inhibiting market efficiency. And to the extent we move and oscillate between those 2, you can have comfort about strategy. And so if I were looking at the market language in earlier periods in the 20th century to the mid 20th century, we're really concerned about how regulation impedes market efficiency. In the last 40 or so years, but particularly in the last decade or so, the way we look at financial regulation and innovation are more from a justice lens. And I'm not saying one is better than the other, but it's to be informed about how that policy and how you are received as a financial innovator within the system. And the priorities then change depending on the priority of the regulatory and the political class. And so it's really important to recognize what kind of conversation you're entering into. And those 2 things go back and forth. We would think sometimes it's really dictated by the type of, for instance, executive administration, for instance, the President of the United States, or a Prime Minister administration in the UK. But it is wider than that. And so what are the expectations of the regulatory system and then you backtrack into this is how my strategy is going to be impacted. But those change too. They're not always the same. But very loosely, we can sort of say that, is it to increase market efficiency? Is it to somehow hinder a particular product? Or are we on a widespread conversation of the role of finance balancing social justice issues? That will most definitely impact anything, again, that touches a consumer.
So just a quick question on the private currencies.
Sure.
Are there 2 or 3 examples or cases that come to mind if a student wanted to go more in depth? For example, I recently learned that this is not private currency, but that local governments in Germany started issuing currency during the 1920s inflation, hyperinflation period. I didn't know that till literally like yesterday. Are there examples that come to mind that you would research if you want to go further?
And I think you actually don't even have to, in this case, leave the shores of the US. I think probably a lot of people would be very surprised to find out that we primarily had a private currency system for much of our history. Remember, the Fed wasn't founded until 1913, 1914. And so we had, in the case of the United States, individual banks would issue their own banknotes. And that was private currency, if you think about its function. And what I think you can learn from that, again, is how were those individual currencies assessed as risk factors? How much were those notes discounted? How were they widely accepted? What ultimately ended this private competitive banking marketplace, which again issued private currencies? Of course, it was the evolution of the state. And then for those who you have to, of course, understand context, but China had a longer history also of private currencies as well. But for someone who has some familiarity with the United States and United States history, I think you could dive right into just after the Civil War up until 1913 or so. There were private notes issued by individual banks across all of the United States.
And sometimes when they were backed by gold, in order to get your gold, you had to go to a particular location, which may not be easy to get to, and there may be bad actors between you and that location.
Yeah, and what's interesting is when we think of the metal-based system, we always had fractional reserve banking, and so there really was never enough metal in the bank, so to speak. As good as gold really was only as good as credit risk, and so those assessments of value of that piece of paper was dependent on the quality of the issuer, not how much gold that individual bank had, because one of sort of the myths, I think, of understanding the development of finance is that we had a truly metal-based system, which was never really the case. We were awash in credit, and we were awash in paper notes whose value exceeded the metal, so to speak, that was held in the vaults. And all of that can provide, again, lessons for the innovation when it comes to private currencies, because you cannot outrun the fundamentals of supply and demand and the state.
Right. So you wanted to circle back to a couple of other points.
Oh, actually, it was just that idea of appreciating that lens of social justice and market efficiency.
Right.
So that's how I wanted to address that in terms of know the conversation you're getting into.
Right.
And I actually had a question as well. So I know a few questions ago, Professor Godby asked you, can we learn history about cryptocurrency? Is it a store of value? Is it something that we can use long-term? And maybe in the case of here in the United States, we have the full faith of the government, so we know that the dollar is stable. But perhaps in countries like Venezuela and Brazil, where inflation and corruption is right there, can you see the ability and the use of cryptocurrency and blockchain be more viable in countries such as those?
So I think, again, we can get back to, it almost sounds like we're in Econ or Finance 101, but it's what's the market failure? And so if the market failure is, as you said, that there is a lack of trust in the issuer of the currency, whether it's the government who's inflating it away or a private issuer, then we will inevitably, as business, will find alternative routes. And so that alternative route might be cryptocurrency, but I think you'd have to understand what might inhibit that. And it might be type of access, and it might be that the financial system would encourage, perhaps it's really the issuance and use of US dollars, or the use of US dollars, as opposed to a cryptocurrency response. So you'd have to know, I think, the particular context in which you're in. But your question is spot on. And the reality is, if you can identify what the market failure is, then there is a market opportunity. So in this case, it's hyperinflation. And so how does the market and individual businesses respond? What, it's truly most amazing within any regulatory system is the ingenuity of business to create value. And you can look at examples from creating currencies to innovations in credit risk to literally now marrying high-end technology with finance is the ability for people to meet market demands. But the lessons are, understand how the state is going to react, understand why you're creating what you're creating, and what the road to profitability is. Those things don't change.
So I think it's interesting. You've used the word trust several times. Every fintech conversation I've had with every executive, everybody associated with fintech at all has used the word trust or has talked about the concept of trust. But one thing you pointed out that they don't, we're going back to econ or finance 101. A lot of times people don't do that. And I think that's where they get in trouble. So I really appreciate you taking your time today. It's been very educational. And I think this frames it great for students to start using this lens to look at everything we cover, regardless of the fintech application.
Great, thank you. Yeah, but that's an absolute pleasure. And so for anyone who's really interested, of course, we'll plug the book, but it's by Palgrave Macmillan's Handbook of Technology Finance. And the other book I worked on that should be out very shortly is the development of that consumer payday lending markets in Britain. And I look back to since 1870. So it's almost 150 years of how small loan markets operate, develop, and are regulated. So it's exciting